Have you ever stopped to think about how many beginner investors make mistakes that could easily be avoided? These mistakes are often invisible at first, but over time, they can deeply impact your financial success. If you've ever felt unsure about where to start or noticed that your investments aren't going as planned, know that this is completely normal. What truly matters is learning from these mistakes before they harm your results even more. In this video, I will reveal the 10 biggest mistakes beginner investors make and, most importantly, how you can avoid them. With my experience helping people make smarter financial decisions, I'll show you how to avoid pitfalls and start investing with more confidence and security. Shall we get started? Have you ever felt that no matter how hard you try to improve your finances, you never seem to achieve the expected results? This is a common challenge among beginner investors. Many start their journey full of enthusiasm, but encounter mistakes that could have been avoided with a bit more knowledge and planning. Perhaps you've tried investing before but didn't see the returns you expected, or worse, lost money on assets that seemed promising. This often happens when we lack a clear understanding of what we're doing and end up making impulsive decisions driven by emotions or fear of missing out. The problem is that these mistakes aren't just inconvenient. They can seriously affect your financial future. But the good news is that most of them have simple and practical solutions, and today I'm going to share these solutions with you. So if you're tired of making the same mistakes or don't know where to start, keep watching. In this video, I'll show you the 10 biggest mistakes beginners make and how to avoid them so you can achieve financial freedom with more peace of mind. Now that you're aware of the challenges beginner investors face, it's time to focus on solutions. Throughout this video, we'll explore the 10 biggest mistakes you can make when investing and, most importantly, how to avoid them in practical ways. We'll discuss how to plan your investments effectively, the importance of diversifying your portfolio, how to control your emotions in the market, and how to build a long-term investor mindset. These are just some of the topics we'll cover. Each of these mistakes has a direct impact on your financial success. However, by following the strategies I'll share, you'll be able to make more informed decisions and avoid common pitfalls. By the end of this video, you'll have a clear vision of what you need to do to invest smarter and reach your financial goals with greater confidence and security. So, let's get started. The first mistake that many beginners make is not having a clear financial plan. Before investing, it's essential to know where you want to go. Without a well-structured plan, you may end up making random investments which can lead to unexpected losses. Imagine you decide to invest in stocks, but don't have a defined goal. You might sell your stocks during a market downturn or invest in something just because it seems like a good opportunity without considering your long-term plan. This can lead to frustration and even financial losses. The solution is simple. Define your financial goals clearly. Ask yourself, what is my objective with this investment? Retirement? Buying a house? With this clarity, it will be much easier to choose the types of investments that align with your goals. Grab a piece of paper and write down your financial goals for the next 5, 10, or 20 years. Then, create a plan to achieve them. With a good plan in place, you'll have more control over your finances and make more assertive decisions in the market. Another very common mistake among beginner investors is not diversifying their portfolio. Many people make the mistake of putting all their money into a single asset, such as the stock of one company, hoping it will rise quickly. But as we know, the market can be unpredictable. Imagine you invest all your money in a single stock, and it experiences a significant drop. This could damage your entire financial situation at once. That's why diversification is crucial to protecting your investments. The solution to this mistake is quite simple. Spread out your investments. By diversifying across different types of assets, such as stocks, real estate funds, fixed income, and even international investments, you reduce the risk of severe losses. Take a look at your investment portfolio. If you haven't diversified yet, start including different types of assets to build a balanced portfolio. Diversification helps balance risks and increases your chances of achieving consistent and safe returns over the long term. The third mistake is following tips without verifying them. Many beginner investors make decisions based on tips from friends, family, or even influencers without properly researching the asset in question. This can lead to hasty decisions and ultimately financial losses. For example, if someone says, "This stock is going to skyrocket," that's not a sufficient reason to invest without first understanding why they're recommending it. You might be influenced by emotions rather than rational analysis. The solution here is clear. Always do your own research before investing. Understand how the asset works, what risks are involved, and the investment's track record. Additionally, consult reliable sources, such as financial reports and expert analyses. Before investing in any asset, take the time to research it, understand the reasons behind the recommendation, and gather more information about the market. By making informed decisions, you'll avoid falling into traps that could harm your financial portfolio. One of the biggest mistakes beginner investors make is not knowing their investor profile. There are different types of investors: conservative, moderate, and aggressive. Each profile requires a different approach to choosing investments. For instance, if you're a conservative investor and decide to invest in high-risk stocks, you might become extremely anxious during periods of market volatility. This could lead to impulsive decisions, such as selling everything during a market dip, which could hurt your long-term returns. The solution is to identify your investor profile. You can do this through online questionnaires or with the help of a financial advisor. Once you know your profile, you'll understand which investments are best suited for you. Take an online investor profile test or consult a specialist to better understand your profile and align your investments accordingly. Investing in line with your profile will help you avoid emotional stress and increase your chances of achieving your financial goals. A very common mistake is giving in to market pressure. When the market is booming, it's easy to get excited and follow the crowd. However, this herd mentality can be extremely risky. Let's take an example. You hear everyone talking about a stock that's skyrocketing and end up buying it at its peak without analyzing whether the investment fits your strategy. When the market corrects and the stock's price drops, you could lose money. The solution is to stay calm and stick to your investment plan, even when market pressure is high. Markets will have ups and downs, but your strategy should be built for the long term. Actionable tip: when you feel pressured to follow market trends, take a deep breath and check if your strategy aligns with what you truly want to achieve. Benefit: this will prevent impulsive decisions and ensure your investments remain solid over time. Another critical mistake is ignoring investment costs. Many beginner investors don't realize that every investment comes with associated costs, such as brokerage fees, fund management fees, and taxes. These costs can significantly reduce your profits over time. For example, when you buy stocks, you pay a brokerage fee. If this fee is high and you make frequent trades, it can substantially impact your returns. Additionally, investment funds often have management fees that, if too high, can eat away at your earnings. The solution is to understand all costs involved before making any investment. This includes not only brokerage and management fees, but also income taxes on investments. Review all the costs of your current investments and research other options with lower costs without compromising quality. By doing this, you'll maximize your gains and avoid unpleasant surprises in the future, increasing your net profitability. Many beginners make the mistake of having unrealistic expectations about investment returns. The promise of quick and easy profits is very appealing, but it's important to understand that the financial market doesn't work that way. Expecting exorbitant returns in a short time can lead to frustration or even excessively risky choices. For instance, investing in highly volatile assets expecting immediate and risk-free returns can be a trap. When this doesn't happen, many investors become discouraged or try to recover their money impulsively, which can lead to even greater losses. The solution is to adjust your expectations. Have a realistic view of what you can expect from your investments, considering the time needed for them to bear fruit and the risks involved. Reflect on the type of return you're expecting from your investments and whether it aligns with the type of asset. and the time you can wait to achieve your goals. This will help you exercise more patience and emotional control, avoiding hasty decisions that could negatively impact your long-term results. Investing with emotions running high is one of the biggest mistakes you can make. Fear and greed are the emotions that most influence beginner investors' decisions. When the market is booming, you may be driven by greed, buying assets without analyzing the risks. On the other hand, when the market is down, fear can lead you to sell everything in a panic. These emotionally driven decisions are often disastrous. For example, during a market dip, many investors sell their stocks in panic, only to miss out on recovery opportunities later. The solution is simple. Stay calm and avoid making impulsive decisions. One way to do this is to always remind yourself that investments are for the long term and that market fluctuations are part of the process. Actionable tip: create a clear investment strategy with long-term goals. This will help you resist the temptation to act impulsively when the market is volatile. By controlling your emotions, you'll make more rational decisions and increase your chances of success in investing. Many beginner investors make the mistake of not reinvesting their profits. When you receive dividends, interest, or other types of returns, many people tend to spend that money or leave it idle. However, the real power of investing comes from reinvesting those profits, when you let your earnings generate more earnings. For example, if you own a fund that pays dividends, reinvesting those dividends instead of spending them will increase your investment power and benefit from compound interest, one of the most powerful tools for long-term investors. The solution is to reinvest your profits automatically. Many banks and brokerages offer options to reinvest dividends and returns automatically, making this process much easier. If you haven't started yet, check with your brokerage or investment platform to see how you can set up automatic reinvestment. Reinvesting your profits amplifies your returns, allowing your money to work more efficiently for you over time. The last critical mistake is not regularly monitoring your investments. Many beginners think that once they've made their investments, the job is done and there's nothing more to do. However, this isn't true. The market is constantly changing, and your investments need to be monitored to ensure they're still aligned with your goals. Imagine you made a good investment, but over time, the company or fund you chose started to underperform. If you don't monitor your investments, you could end up holding on to a losing position longer than you should. The solution is regular follow-ups. You don't need to monitor daily, but periodically review your portfolio's performance and check whether the assets still fit your strategy and goals. Actionable tip: dedicate some time each month to review your investments, analyze market changes, and assess your portfolio's performance. This allows you to take quick actions like reallocating your resources, selling underperforming assets, or seizing new opportunities that arise. Now that you know the 10 biggest mistakes beginner investors make and how to avoid them, it's time to take action. Remember, in the world of investing, time is money. Every day you wait to implement these strategies is a day your investments could be growing. Don't let fear or indecision hold you back. The journey to financial success starts with the first step, and the fact that you're here, learning and improving your financial knowledge, is already a huge step forward. So what are you waiting for? Start applying what you've learned today. If you enjoyed these tips and feel you now have a clearer understanding of the mistakes to avoid when investing, I'd love to hear from you. Leave a comment below sharing which mistake you've made before and what you'll do to avoid it moving forward.
And don't forget to like this video and subscribe to the channel so you don't miss any content on improving your financial life. Share this video with friends and family who could benefit from these tips as well. Together, we can create a community of more conscious and successful investors.
Remember, the journey to financial freedom isn't a race, it's a steady walk. With each step, each well-thought-out decision, you're getting closer to achieving your goals and ensuring a prosperous future. It doesn't matter where you are today. What matters is that you've decided to learn and improve, and that makes all the difference. You already have everything you need to succeed in investing. With patience, strategy, and the right mindset, you can overcome challenges and reach your financial goals. So don't waste any more time. Start putting what you've learned into practice today and take the first step toward transforming your financial life. Each small improvement you make will bring you closer to building a safer and more stable future for yourself and your family. Thank you for watching this video all the way to the end. If you found it helpful, don't forget to like, comment, and share it. Your support helps this channel grow and reach even more people looking to improve their financial lives. See you in the next video.